Are you making a decision on whether to register as a sole trader or a limited company? If so, then this video is for you. Throughout the video, we'll be looking at a like-for-like comparison between the two options, including liabilities, taking money out of the business, taxes, and more. The process of setting up as a sole trader is easier and more straightforward than setting up as a limited company. I say easier, it's not necessarily hard to set up as a limited company. Becoming a sole trader is easy because all you have to do is inform the HMRC and register as self-employed if you've earned more than £1,000 in a given tax year, which runs between 6th of April to the 5th of April. But bear in mind, the value of £1,000 may change over time. Registering with HMRC is quick and simple, and you can do so by filling in a form online. Then HMRC will send you a 10-digit code via post, which is called your unique taxpayer reference number. This can take somewhere up to about 2 weeks. Once you've got your UTR number, you can then start accessing the online portals and paying for your personal tax. When you set up as a sole trader, it's important to note that you can use your own personal bank account for operating the business, and hence you can be up and running in no time. Luckily for you guys, I've prepared a step-by-step video on how to register as self-employed using the safest means possible via the gov.uk website. I say safe, it's not necessarily dangerous to use any other means, but there are some third-party services that offer to open up a business on your behalf. They're not necessarily dangerous, but you are giving your details, your personal details, out to third parties. A link to that video should pop up any moment now, and I'll also add a link to that video in this video's description. The process of setting up as a limited company certainly isn't the hardest thing in the world, but it takes slightly longer due to the application being a little more thorough. It also costs £12 to register a limited company with the Companies House, and although that isn't the end of the world, it's still £12 more than it costs to register as a sole trader. You're also required to open a completely separate business bank account for limited companies, which can take up to around 10 days. And luckily for you guys, again, I've prepared another step-by-step tutorial on how to register as a limited company using the gov.uk website. That should also be popping up any minute now, and I'll also be featuring that in this video's description. The next thing to discuss are liabilities. And if you're wondering what liabilities are, then we're usually referring to liabilities in terms of debt. If you've ever wondered where a limited company gets its name from, then look no further, as we're about to answer that right now. A limited company is a completely separate entity to its directors, and the liabilities for a limited company are limited to the company and hence the name. In layman's terms, if a limited company gets sued, can't pay back its debt, or gets itself in any sort of trouble, then it's treated as its own separate entity. You'll hold certain responsibilities as a director. However, if you're being sued, then whoever is suing the company will only be able to come after the company's assets and not your personal assets as a director. And that's because the company's assets belong to the company and not yourself. So essentially, you're not liable for financial losses by your business. Having said that, this is slowly changing over time, and directors have become increasingly more responsible for unpaid debts, and companies are catching on to this and adding certain things into contract clauses, particularly when taking out certain loans, meaning you could be liable for paying back the debt as a director. On the other hand, if you're running a company as a sole trader, you are the business. All of the assets belong to you, so if you get sued, you are personally being sued. If you've taken out big loans and you can't pay them back, then the lenders can come after your personal assets, even if they're not associated with your business. In summary, unless you sign a personal guarantee, referring back to the contract clauses we very briefly mentioned a second ago, or trade fraudulently in a limited company, then a limited company is always limited in the sense that its owners are not liable for its debts. Some people might see a limited company as a type of insurance policy, especially for new or high-risk businesses. Having said all of this stuff, don't let it scare you. These are just rules, and just because we're talking about getting sued and liabilities and so on, if you operate the business as you should, then you won't need to worry about this stuff. Although you have unlimited liabilities as a sole trader, on the positive side, the company's assets belong to you, so it's a lot easier and quicker to access your cash. It's great if you're running a limited company, but there's also slight drawbacks associated with them. Since the assets belong to the company and not you, as we've discussed, it's generally a little harder to access your cash. I say harder, it doesn't necessarily mean it's hard. For example, if you want to take out dividends, you'll need to get your accountant to do a review of the accounts and calculate your profit and cash reserves after all expenses and taxes have been paid, which may take some time. So it's not as simple as having money in your personal account and taking it out as and when you need, which is how it works if you're registered as a sole trader. As a director and shareholder of a limited company, you have the legal right to pay yourself either as an employee through the PAYE scheme or through dividends or both. It's a common misconception that directors can receive dividends, but this is completely wrong. Only shareholders are able to pay themselves dividends, so you'll need to make sure you set up the company correctly at the start. I've covered this in a step-by-step video on how to register a limited company, so please, if you're unsure, do watch it, and again, it should pop up any moment now. As long as you've paid your taxes as a sole trader, you can take out as much cash as you like from the business account, use it for yourself, and HMRC won't be coming after you. However, it's important to note that you won't be able to claim tax relief on it. As a sole trader, you can offset your profits by a variety of expenses used for business, such as travel costs, advertising and marketing, training courses, and clothes. You can actually find a full list of this by going onto the gov.uk website. I'll add a link to this in the video's description. The only time you can't claim tax relief on those expenses is if you use up your £1,000 tax-free trading allowance, which is another form of tax relief some sole traders use. Although that sounds like a massive difference, it's important to note that the tax paid in the scenario of being a sole trader is the total tax you'll pay for that given year. However, the tax paid in the scenario of a director limited company, that's just your personal tax bill. You'll also have another 19% corporation tax to pay on profits between £0 to £300,000. So in summary, when comparing the two, you pay slightly more tax with a limited company until a certain point, and then it becomes much more tax efficient to run a limited company. Luckily for you guys, I've prepared a graph to compare the two and show you the turning point whereby paying tax for a limited company becomes more cost effective in comparison to paying tax as a sole trader, and that will come up any second now. The final thing to note is that sole traders also pay national insurance as well as income tax, which we've slightly touched on in the example, whereas limited companies don't, unless their employees are on the PAYE scheme and earn over a certain amount, which is around £850 a month. But do double check that figure as it's constantly changing every year. As sole traders are seen to be slightly riskier than other business structures, they are less likely to secure funding from traditional sources such as banks. Raising funding for your sole trader business can be slightly more difficult than a limited company. Therefore, any entrepreneurs will need to weigh up the options and see if they can either find another method of funding or change the business structure. Although it's worth pointing out that sole traders usually have lower startup costs requiring minimum funding in comparison to limited companies. A limited company has to register with Companies House and provide information which is then stored on a public register. When registering a limited company, you'll have to provide business details and details on the directors and shareholders involved in that company. This then reduces the privacy of the business. Contrary to that, as a sole trader, you don't have to register your business with Company House, and this means that your details are stored completely privately and they can't be accessed by anyone in the public. Having said that, if you do decide to register as a limited company and want to keep your address private, then you could always utilize something which is called a virtual address. It's a service where you can utilize a more professional address, usually located in the city centre. It costs about £100 a year. and they usually include a mail forwarding service with that cost. If you are interested in utilising a virtual address, then I'll add a link to a recommended service which I've used in the past in this video's description. Limited companies have a certain prestige that sole traders don't have. This prestige can help with attracting investors and clients, as well as helping to create a professional image of the business. As a sole trader, it tends to be more difficult to create that big business image that limited companies have from pretty much the get-go. For both limited companies and sole traders, your business's accounts mustn't contain any expenses that aren't wholly and exclusively used for the business's trade. So if you do go ahead and buy that private jet and you only use 50% for the business, you can put 50% of the cost of running the jet through the business's accounts. But the other 50% is private expenses and must be kept out of the business's accounts, or alternatively, if you do put it in, you must add it back as disallowable expenses when you do your tax return. So you won't be able to claim tax relief on 50% of that cost. Unless you can accurately identify part of the expense is just for business and part of the expense that is private, you can't put any of the cost through your business account. It will just go to drawings. HMRC will only get upset if you put the private jet through the business accounts and try to claim tax relief on it. Or of course, if you take so much money out of the business, you can't pay the business's dues and it subsequently goes down the tubes. Sole traders benefit from being able to claim a proportion of almost all household expenses against tax for the proportion of the household which is being used solely for business purposes, whereas directors cannot. The difference between the two essentially boils down to limited companies being able to expense slightly more in certain areas. For example, a limited company can claim tax relief on childcare costs via childcare vouchers up to a total value of £243 per month. If your home is the heart of your business, you're able to claim a percentage of your household costs and utility bills as business expenses. When operating a limited company, if you set yourself or anyone else up as an employee on a pension plan, then that cost can be considered a business expense and hence can be deductible from your profits, whereas this can't be done as a sole trader. It's not a legal requirement for either a sole trader or a limited company to have an accountant, although it is usually advisable to seek the services of a suitably qualified accountant, as they will prevent you from making costly errors, prepare your year-end statutory accounts, and almost certainly reduce your tax charges if you have a half-decent accountant. I would strongly advise finding a good accountant from the very start, regardless of whether you're setting up as a sole trader or a limited company, and avoid anyone who tells you they're going to save you money here and there in illegal ways. This is not only extremely short-sighted, but you're also asking for trouble. If you don't get any trouble in the short term, I can guarantee you will live a life of paranoia. Finding a good accountant who can build a relationship with you will inevitably not only save you costs where possible, but they've been dealing with businesses their whole careers. They've seen what works and they've seen what doesn't work. They know why some businesses succeed and some fail. So if you build a great working relationship with your accountant, there's no reason why they won't be able to share some of this information with you and advise you properly in growing. Sole traders, on the other hand, can definitely get away with using accounting software such as QuickBooks to do their accounts, which will turn out to be a lot cheaper than hiring an accountant, but they won't necessarily give you any advice. I'll add a link to some good accounting softwares in the video's description, so feel free to check them out. Regardless of whether you run a business as a sole trader or a limited company, you can always employ people and remain a sole trader if that's how you started. There's no need to set up a limited company if you don't want to. And although sole traders operate the business on their own, that doesn't mean that they have to work alone. You can still employ an unlimited amount of resources to help you grow the business. The term sole trader simply means that you're trading as yourself under your own name and not a separate legal entity or a limited company. Regardless of which business you choose, it's important to note that you can employ permanent, part-time or freelance basis workers, whatever suits you best. However, if you do employ people, you need to start thinking and educating yourself on running payroll. If you have an accountant, they'll help you with that, at least do most of the work anyway. Employees' national insurance and employee benefits like holiday, maternity and sick pay. One of the first things you'll need to do is register as an employer through HMRC in order to run payroll. This involves setting up on PAYE, which is a system for deducting income tax and national insurance from eligible employees and paying it onto HMRC on their behalf. So if you do decide to go down that route of employing people, again, I highly advise hiring a decent accountant. They will be looking after all of this stuff for you. Registering a trademark isn't affected by the type of company you run, and you can register a trademark either under your personal name, as a sole trader, and as a limited company. The only thing to note here is that if you register a trademark through a limited company, the trademark can act as an asset and will belong to the company and not you personally. If you are running a limited company and want to register a trademark, then I'd advise you to use the company details when registering that trademark as opposed to your personal details. If I'm running a limited company and I want to register a trademark, however, I use my personal details to register that trademark, and in 3 years' time I want to sell my limited company, the buyers will look into who owns that trademark, and if the company doesn't own the trademark, which is arguably where the value lies, then there'll probably be quite a few issues when selling the business on, and you'll have to do some rejigging. So I'll just set that up properly from the start and register any trademarks for limited companies under the limited company details. Luckily for you, I've created a step-by-step video on how to register a trademark successfully by going through live examples, and that should pop up any moment now. I'll also add a link to that video in this video's description. The last thing you want to look at when opening a company is whether you want to voluntarily register for VAT. In most cases, this won't be financially beneficial to do so, but it will actually in some cases. The topic of VAT itself is quite extensive and you can dig quite deep into it. And for the sake of keeping this video relatively short, I've made 2 separate videos on VAT, one on flat rate VAT and one on the standard rate scheme, which should pop up now and will also be featured in this video's description. I'm going to now wrap up the video by summarising what we've discussed and giving you some of my personal recommendations. A good thing to note is that if you want to start small and expand later, operating as a sole trader allows you to do that. You can easily change your business structure later on. For example, if your sole trader business starts to see an increase in income, you might find it more tax efficient to start running your business as a limited company, and you can quite easily do that. It's not a complicated process, and any decent accountant will be able to do this on your behalf. To make a final decision on whether you should be registering as a sole trader or a limited company, each decision needs to be looked at individually. But since there's going to be more than one person watching this video, I know saying that won't necessarily help, so I'll try and put things into perspective. In most cases, if you're not expected to make more than £30,000 worth of profit in your first year, then you're better off starting as a sole trader. And then if your revenue and profit increases over time, then changing the business into a limited company later on down the line is a very simple process and can be done by an accountant on your behalf. Having said that, in some cases, you might want to start off as a limited company, particularly if there's going to be more than one person involved as a director, since you can split limited companies by shares. Or maybe your goal is to develop a business that has the potential to scale really quickly, in which case you wouldn't want to be wasting your time setting up as a sole trader and then very soon after changing the business structure into one of a limited company. For now, I hope you've enjoyed the video. If you have, please like and subscribe to my channel. But most importantly, if you have any questions, then drop them in the comment section below.